Hi, I'm Dan Passarelli with Market Taker Mentoring at markettaker.com. Today, I want to talk about setting up time spreads. Time spreads are reasonably commonly used strategies, but the problem is a lot of traders oversimplify them. They don't look at the things that they need to look at to make the trade a sound trade from an edge standpoint, from a statistical standpoint, and they don't think it through enough. So today I'm going to talk about how to set up an excellent time spread. The basics: a time spread is simply when a trader buys a call in one month and sells a call in another month. The trade can also be done with puts. Typically, an income trader, which is the more common way of setting up a time spread among non-professional traders, typically a trader buys the longer term call option and sells a shorter term call option. Now, both of these options share the same strike. The gist of this trade all has to do with a little quirk of how theta is calculated via the trading model. The less time there is until expiration, the higher theta an option has. So with the time spread, a trader is buying an option that has a small theta, selling an option that has a big theta. Therefore, the trader collects time decay as each day passes. Now, that's the basics, and the problem is that's where a lot of people kind of stop thinking about it. They just figure, oh, as long as the stock stays in a range, I make money on my time decay. Here's the key to getting an edge on a time spread. You have to look at the implied volatility levels. Whenever I set up a time spread, I always look at what's known as the term structure of volatility. I look at the implied volatility of the option I'm buying and the implied volatility of the option that I'm selling. It's imperative that the option you're selling has a higher implied volatility than the option that is being purchased. Basically, what you're doing is you buy low, sell high at the same time. This gives a trader a statistical advantage. This makes the theta collected every day somewhat higher than it should be. As long as the stock stays within a range, the trade works out. This is kind of the basics that everybody knows, but when a trader puts on a time spread for this volatility edge that I'm discussing, the trader is at a statistical advantage, and though some of these time spreads will work out and some of them won't, in the long run, that statistical advantage is what adds up. This is Dan Passarelli with Market Taker Mentoring. Visit markettaker.com for more information.